Before we delve in, I'd like to first recap on the workings of the two-pot retirement system. So as we know, the two-pot retirement system became effective on 1 September 2024. The vested component of a member's accounts consists of their accumulated investments up until 31 August 2024, being the two-pot vested benefit and the harmonization vested benefit if applicable. A member cannot make additional contributions to their vested component. However, a member's previous rights continue to apply to their vested component, meaning that the vested component is not impacted by two-pot. The savings component was seeded with an initial amount transferred from the vested component of a member's account on 1 September 2024. And 1/3 of contributions since then are allocated to the savings component. Prior to retirement, a member can make a withdrawal of at least R2,000 per tax year from their savings component, and at retirement, a member can take any remaining balance in this component as cash, or they can use it to purchase a retirement income product, such as a living annuity or a guaranteed life annuity. 2/3 of contributions made from 1 September 2024 are allocated to the retirement component. The full amount in a member's retirement component must be preserved until retirement. And then at retirement, a member must use the full amount in this component to purchase a retirement income product. What this means is that a member cannot withdraw a cash lump sum from their retirement component either before or at retirement unless the de minimis rule applies. With regards to tax on cash benefits, these differ based on the components. With the vested component, pre-retirement withdrawals are taxed on the withdrawal tax table, whereas the lump sum benefit at retirement is taxed on the retirement tax table. With regards to withdrawals from the savings component, those are taxed at a member's marginal rate in the year of withdrawal, and the lump sum benefit at retirement is taxed on the retirement tax table. As there are no pre-retirement withdrawals and no lump sum benefits at retirement from the retirement component, no tax is applicable there. With regards to transfers between retirement funds, transfers between components in the same fund, as well as seeding, there are nil tax directives that are required for these transfers. We have encountered issues with regards to Section 14 transfers since the implementation of two-parts, whereby transferring funds were not providing us with component splits. A few transferring funds have advised that the reason for not providing splits is due to members being paid up in their records, and thus they treat those members as not being members of the fund. I pause to say that this reason is incorrect if you look at the definition of deferred pensioner in the Pension Funds Act. The definition there states that a deferred pensioner, which is also otherwise known as a paid-up member, is a member who has not yet retired but has left the service of the employer concerned prior to normal retirement date, but leaving in the fund the member's rights to such benefits. Not receiving component splits means that we were unable to invest members timeously, with this then having a knock-on effect of members being unable to access their pre-retirement withdrawals where applicable, and being unable to eventually retire into a living annuity and obtain an income. At Allan Gray, our operations teams have been working tirelessly, engaging with fund administrators on this issue, and we have seen since an uptick in outstanding cases being resolved. We now move to the legislative updates pertaining to the two-pot retirement system. So, the Revenue Laws Amendment Act was promulgated on 24 December 2024. However, due to the urgency of the enactment, some important technical corrections could not be added. And it is for this reason that a further draft Revenue Laws Amendment Bill 2025, which I'll discuss in a moment, was released on 10 December 2024, and it was open for comment until 17 January of this year. The changes that were introduced by the Revenue Laws Second Amendment Act provides that the savings pot may be paid in cash to a retiring member on their election. Any portion that's not paid in cash when the member chooses to retire can be annuitized, and this amount does not have to be transferred to the retirement pot first to enable annuitization. With regards to transfers, although this was already industry practice, the requirement that tax directives must be applied for on intra-fund transfers, that is, transfers between pots in the same fund, has now officially been withdrawn. With regards to the savings withdrawal benefits, where a member exits a fund upon leaving service, the Act provides that a member who exits with a savings pot balance of less than R2,000 will be able to withdraw it. This withdrawal applies regardless of whether the member had taken a savings withdrawal benefit in that same tax year. The reason for this is to ensure that small balances are not left in the funds. With regards to exemptions from the two-pot system, exemption is given in the Act to any member to whom an unclaimed benefit was due as at 31 August 2024. Before this change, the Income Tax Act only exempted unclaimed benefit funds. Further exemptions in the Act also include any fund where a liquidator has already been appointed by 31 August 2024, and any fund with no member assets immediately before 1 September 2024. The Act also replaced certain provisions contained in the Revenue Laws Amendment Act of 2024, which was the enabling legislation for the two-pot retirement system. The replacement of certain provisions has created issues which need to be corrected. The first replaced provision is that Provident and Provident Preservation Fund members who were 55 or older on 1 March 2021 must still be members of the same Provident or Provident Preservation Fund in order to be excluded from the two-pot retirement system. The inclusion of Provident Preservation Fund members is not in line with Treasury's initial intention. With regards to the second replaced provision, this relates to the election to opt in. The election whether to participate in the two-pot retirement system must take place within 12 months, therefore before 1 September 2025. So if a member makes an election, the Act provides that 10% of the seeding balance must be calculated on the last day of the month during which the election was made and allocated to the savings pot on the last day of the month of election. So the current lack of a seeding calculation date in the Income Tax Act and the different calculation dates that were specified in the different versions of the bill prior to enactment created an anomaly for funds, as some funds had the seeding calculation done on 31 August 2024, while other funds based the calculation on the last day of the month that the member elected to opt in. This therefore requires a fix. So the 2025 Draft Revenue Laws Amendment Bill seeks to correct the two previous issues. The definitions of retirement component and savings component are to be amended to make it clear that the requirement that a member must still be a member of the same fund in order to be excluded from the two-pot system does not apply to a member of a Provident Preservation Fund. So unlike the situation that applies in the case of a Provident Fund member, a Provident Preservation Fund member who is 55 or older on 1 March is accordingly excluded even if they are no longer a member of the same fund that they were a member of on 1 March 2021. Provident and Provident Preservation Fund members who are excluded from the two-pot system under these circumstances still have the option to participate in the system, in which case they must elect to do so by 1 September 2025. The draft bill also seeks to clarify the seeding calculation date. So if a member elects to participate in the two-pot system, the seeding amount must be based on the value of the member's vested component as at 31 August 2024 or on the last day of the month in which the election was made. This is to be determined in the rules of the fund. What this means is that a fund can accordingly, with regards to Provident and Provident Preservation Fund members 55 or older on 1 March 2021, the funds can base the seeding amount on the value of the member's vested component on either of these dates. This then gives optionality for funds to select whichever approach was communicated to their members and outlined in the fund rules. I'll now hand over to Meagan, who will delve into some insights that we have obtained since the implementation of the two-pot system.
Thanks, Felicia. When looking at the latest published industry statistics, as of the 1st of February 2025, SARS confirmed that more than 2.4 million South Africans cashed out from their savings components to the tune of a whopping 43 billion rand. The FSCA further confirmed that a total of 6.5 million people are currently contributing to retirement funds. What this means is that almost 40% of South Africans' retirement fund members withdrew a portion of their retirement savings, ultimately reducing the amount that will be available to these members at retirement. From a tax directive perspective, SARS also confirmed that almost 2.67 million tax directive applications were received by them, but almost 300,000 of these were rejected due to a variety of reasons, including incorrect identity and tax numbers. As we navigate the new complexities around retirement savings in a two-pot era, there have been some common misconceptions that have arisen amongst retirement fund members and advisors. I am going to take some time to debunk some of those misconceptions now. The first and most common misconception that we have seen is that the annual withdrawal limitation results in a use it or lose it scenario, similar to the annual contribution limits currently in place for retirement fund and tax-free investment contributions, as well as the annual CGT exclusion amount of 40,000 Rand. However, when it comes to savings pot withdrawals, this is not the case. If an investor chooses not to withdraw from their savings component in any one tax year, the amount available to them will not fall away. The amount accumulated will simply remain in their savings component, earning capital growth and income until such a time as the member chooses to withdraw or retire. Future contributions to the fund will also result in 1/3 being allocated to this component, allowing for further compounding. It is also important to remember that any capital growth and income earned by the member in this component remains tax-free whilst they are invested in their retirement product. So this component does not function in the same way as a discretionary product would, despite the fact that it is termed the savings component. The other consideration to keep in mind is that the annual allowable withdrawal amount per member is the full amount available to them in their savings component when they do elect to withdraw. So this means that they will not lose any access to these amounts should they elect not to withdraw from this component in any one tax year, and members can access the full amount in future years should they have the need to do so. The second misconception is around the taxation of savings component withdrawals. So one of the biggest taxation considerations to be made when thinking about dipping into your savings component or when advising a client on whether this is a savvy financial decision is the fact that the withdrawal will be taxed at the taxpayer's marginal tax rate. So savings component withdrawals are not classified as retirement fund lump sum benefits and therefore are not subject to the withdrawal or retirement tax tables that we are also used to applying to funds coming out of retirement products. The good news, however, is that this means that a member's tax-free amount per the retirement fund lump sum tax tables is in no way reduced by the savings component withdrawals that a client may elect to take over their lifetime, leaving that full 550,000 Rand tax-free amount available to members when they do retire. Just bear in mind that this is provided that they have not taken any prior retirement fund lump sum amounts, as these will be taken into account when calculating the tax at retirement. So now that we know that taking a savings component withdrawal in no way affects the retirement lump sum tax that a member will be liable for when they retire, let's remind ourselves of the actual cash amounts that will be available to members to take at retirement. The first thing to remember is that the old retirement rules will still apply to amounts in the vested component. This component comprises of the value in the fund as at 31 August 2024, less the amount that was seeded on the 1st of September into the savings component. This amount may be comprised of harmonization vested and unvested amounts as well. I'm going to talk through a Provident Fund example where the member was subject to Provident Fund harmonization on the 1st of March 2021. So all harmonization vested benefits, which comprises of amounts contributed to the member's Provident Fund prior to harmonization implementation date, will be available to the member to take as a cash lump sum. These benefits retain the rights they had prior to 1 March 2021. The remainder of the vested components, or two-pot vested amounts, will be subject to the previous retirement rules, meaning that 1/3 is available to be taken in cash, and the remaining 2/3 is required to be transferred into a living or a guaranteed life annuity. The remaining two components, or our two pots as they were previously known, will have been subject to an upfront component split when the member made contributions to the fund, and therefore the savings component value at retirement is the cash amount available, and the retirement component cannot be taken in cash, and it is compulsory to annuitize this amount. So back to those common misconceptions that we were previously discussing. Based on those amounts that will be available to the member to take as cash at retirement, the third misconception that we have seen is that the portion taken from the savings component as cash at retirement will still be taxed per the member's marginal tax rate. This is not the case, and once a member elects to retire from the fund, the full cash value that the member elects to take will be subject to the retirement lump sum tax tables, regardless of the components that the cash election stems from. This should further encourage members not to dip into their savings component before retirement date, as the rate that will be applied per the retirement tax tables is more favourable than a member's marginal tax rate. So here at Allan Gray, we have also been paying keen attention to some of the savings withdrawal trends experienced in our own retirement products. So between the launch of the two-pot system on the 1st of September 2024 and the 28th of February 2025, or the end of the tax year, Allan Gray had processed a total of 17,323 tax directives relating to savings component withdrawals. Of these, around 900 had additional penalties and outstanding taxes paid over to SARS. Remember that this is over and above the income tax that was owing on the actual withdrawal amount. In addition, around 240 clients had the full after-tax amount claimed by SARS for outstanding taxes and/or penalties, and therefore these members did not receive a payment into their bank account at all. In the first week of March, we saw an uptick in members submitting instructions for their newly available 2025-2026 savings component withdrawal. Just under 400 directives were finalized within this week. 45% of these members were dipping into their retirement savings for a second time, meaning that they had also taken a withdrawal in the previous tax year. It is important to note that National Treasury's intention in implementing the two-pot rules was to allow retirement fund members access to their retirement savings in the case of an emergency. And I would encourage that members refrain from creating a habit of taking an annual withdrawal of the full amount available to them in their savings component, as this erodes the total amount of savings that will then be available to them when they get to retirement date. And lastly, we have seen that among retirement fund members who have appointed a financial advisor, a large percentage have submitted their withdrawal instructions to Allan Gray directly via their own online account and not via their advisor. So we are all aware that life happens and that members may indeed find themselves in a position where they are in need of cash due to an emergency. But I do encourage advisors to have honest conversations with their clients regarding the most financially savvy manner to access liquidity in these scenarios, as the long-term implications of dipping into their retirement savings may outweigh the benefits. So for those of you who do have clients who have already taken a savings component withdrawal due to the fact that they were in a position where they would have been worse off had they not, you may be wondering what additional considerations you need to take into account when you are looking to implement strategies for the future of their overall financial plan. It is advisable that for these members, we think about the steps that they may need to take in order to ensure that they replenish those amounts that they previously withdrew from their savings component. So let us take a moment to think about how we get these members back on track. As I mentioned earlier, the one large consideration to be taken into account before taking a withdrawal is that marginal tax rate that will be applied. But this is also an important point to remember when we speak about the considerations we need to take into account when looking to replenish these amounts, as the amount previously withdrawn from the fund will be higher than the actual amount of cash that the member would have received in their bank account. So bear this in mind if you are looking to place the member into the same position as they would have been had they not withdrawn, as you need to look to replenish the savings component with that gross amount that was taken, which does include an amount that was paid over to SARS in lieu of taxes. There are a couple of additional things I want you to think about when dealing with this scenario as well. The first thing is that it is important to remember that in the new two-pot era, the amount available in a member's savings component will generally be all that will be available to be taken as cash at retirement. This is of course excluding the cash amounts available to them in their two-pot vested component, as well as any harmonization vested amounts, which we discussed earlier in our Provident Fund example. So this means that any savings component withdrawals taken prior to retirement will reduce the cash available to the member when they do reach retirement. So if your client will be in need of liquidity at retirement date, in order to settle an amount owing on their home loan, for example, or vehicle financing, focus on putting measures in place to replenish this component to allow for the member to receive a cash lump sum at retirement date. What we may neglect to take into account when thinking about replacing the withdrawn amount is that all future contributions will automatically be split between the savings and the retirement components. So only 1/3 of these contributions will actually replenish the savings component itself. What this means in practice is that for every additional 30,000 Rand that a member contributes to their retirement fund today, only 10,000 Rand of this will find its way into the savings component. So effectively, they will need to make up for their withdrawal with contributions that are 3 times the value of the amount originally withdrawn. Thirdly, we want to remember that between the date of savings component withdrawal and the date of replenishment, the member would have missed out on capital growth and income within the fund. This means that the amount needed to replace the member in the same position that they would have been had they not withdrawn will be higher than what was actually withdrawn. I'm going to hand over to Felicia now, who will take us through some new amendments when it comes to divorce orders.
Thanks, Meagan. We will now discuss how the two-pot system impacts divorces with regards to the sharing of pension interest. When we look at the Divorce Act makes a distinction as to how pension interest is calculated as it relates to retirement annuity funds and all remaining funds. In relation to a retirement annuity fund, the term pension interest is defined in the Divorce Act as the total amount of the member's contributions to the fund up to the date of divorce, together with annual simple interest on those contributions at the prescribed rate. In relation to all remaining funds, pension interest is the value of the benefits that the member would have been entitled to in terms of the rules of the fund if his membership in the fund would have terminated on the date of divorce. The Pension Funds Amendment Act has made the calculation of pension interest the same for all retirement funds. The definition states that pension interest is the total value of the member's individual accounts in the fund as at date of divorce. Please note that this definition prevails over the definition that is set out in the Divorce Act. Further provisions that were provided by the Pension Funds Amendment Act is that previously, pension interest was always calculated at fund level, regardless of whether a divorce order referred to a specific account in the fund. As of 1 September, we now apply pension interest on an account level if this is specified in the divorce order. I wish to also note that funds are permitted to pay divorce claims to the non-member spouses of members who are members of umbrella funds and who were paid up members on the date of divorce. This then ensures fairness in cases where, during divorce proceedings, a member resigns from their employment but remains in the fund. The division of assets differs based on the marital property regime of the divorcing parties. So if married in community of property, the division of the 3 parts is relatively straightforward. All assets, including those in the new retirement system, will be divided equally between the spouses as dictated by Section 77A of the Divorce Act. This has not changed with the introduction of the 2-part system. The key difference is that the new parts, specifically the savings part, is now included in the equal division. The 2-part system introduces some additional considerations for marriages out of community of property with accrual. In this type of marriage, the spouse whose estate has grown more significantly is obligated to compensate the other spouse to equalize the growth during the marriage. So introducing the 3 parts may make this process a bit more complex. Since the savings part has its own distinct value, it must be included in the accrual calculation. This means that the final division of assets may depend on whether or not the savings pot was accessed or depleted during the marriage. So considering these complications when negotiating divorce settlements, if married out of community of property with the accrual, is therefore very essential. With regards to marriages out of community of property without accrual, there is no impact as each spouse retains separate ownership of their assets and liabilities, including those acquired during the marriage, and there is no automatic sharing of wealth or assets upon divorce or death. As we know, a significant change that was brought about by the two-pot system was the introduction of the savings pot. So before the system, save for and interdict against the fund, there was no specific safeguards to prevent one spouse from accessing their retirement savings in anticipation of divorce. But under the new system, spouses cannot access the savings pot freely without consequences. The system includes a protective measure for the non-member spouse during divorce, whereby the law requires that once you initiate divorce proceedings, you should provide a formal written notice to the pension fund. Once the fund is notified, it cannot release funds from the savings pot without both spouses' consent until the divorce is finalized or a court order has been issued. This restriction is aimed at preventing the depletion of retirement savings during a divorce and ensures a fair division of assets. So for those that are contemplating a divorce, they should notify their pension fund as early as possible, because doing so sooner may prevent unnecessary withdrawals and better protect financial interests. The protective measures that are in place for the savings component in divorces also exist for the use of the savings component as collateral for a housing loan. The non-member spouse must provide written consent if the member spouse wants to use the savings component as collateral during ongoing divorce proceedings. Again, this protective measure prevents one spouse from using the savings component to secure a loan that could reduce the funds that are available for a fair settlement and gives the non-member spouse greater control over how they can use their share of the savings, thus reducing the risk of assets being diverted or being used unfairly during the divorce. We now turn our attention to retirement benefit transfers within the two-pot system. So a member spouse still has two options for receiving a pension interest benefit. The first option is to receive an amount as a cash lump sum. If this option is chosen, a tax directive is requested from SARS in the non-member spouse's name, and any tax that is due is deducted from the amount awarded to the non-member spouse and paid over to SARS. The second option is to transfer the pension interest amount to another approved retirement fund. If this option is chosen, the transfer will be tax-free in both the hands of the member and the non-member spouse. So once a fund receives a divorce order mandating the payout of a pension interest to a non-member spouse, the fund will reduce each component of the savings, retirement, and vested pot proportionally. This is otherwise known as the mirroring principle, which is directed by Section 6B of the second schedule of the Income Tax Act. Using arbitrary numbers, we are now going to look at an example of how a fund would handle a divorce order where the non-member spouse has elected to transfer the pension interest amount to their own retirement fund. So divorce allocations to non-member spouses following the transfer option should mirror the components from which they were transferred. In this example, the member has 10,000 Rand in their savings component, they have 70,000 Rand in their vested component, and then they have 20,000 Rand in their retirement component. When the fund receives the divorce order, the final order makes provision for the non-member spouse to obtain 50% of the member's pension interest in the fund. What this then means is that on transfer, the non-member spouse's account should mirror 50% of the member's account. This means that the non-member's account should have 5,000 Rand in their savings component, it should have 35,000 Rand in their vested component, and it should have 10,000 Rand in their retirement component. With regards to Section 14 transfers, in June 2024, the Financial Sector Conduct Authority released Communication 21 of 2024. The issue for clarity was how funds and administrators should treat Section 14 transfers over the period of transitioning to the two-pot system in instances where a transfer was still in process on 1 September 2024 and for new transfers as of 1 September 2024. In particular, clarification was required in relation to the seed capital allocation, the payment of savings withdrawal benefits, and the allocation of transfer values across the various components. These changes were important in order to ensure consistent treatment across the retirement fund industry, while also ensuring clear communication to members in order to manage their expectations with regards to Section 14 transfers. So any fund that had member assets as at 1 September 2024 had to calculate the seed capital for all members irrespective of the status of the transfer. The transfer value had to be split across all three components, and the membership schedules that were provided to the receiving fund on the transfer of the assets had to show the value in the transferring fund as at 1 September 2024, and it also had to show the calculation of the seed capital. As I mentioned earlier in the presentation, we have encountered issues with the non-provision of component splits from transferring funds. In this regard, we have been in touch with the FSCA to query how cases of this nature should be processed and which fund is responsible for seeding where there is an exit or claim event prior to 1 September 2024 that is only paid to the receiving fund after 1 September 2024. The FSCA has confirmed that the fund that actually holds the benefit, regardless of whether this is in a holding account or not, is the fund that is responsible for seeding the account.